Could the housing downturn be over in the next 12 months? And which country hit their official cash rate to a shocking 69.5%? Let's find out. The housing downturn could be over in the next 12 months, a significantly shorter run than previous cycles, but prices are set to fall sharply in the meantime as interest rate jumps take effect. So we're seeing experts say that the subsequent recovery is also forecast to be slower. It'll take years for house prices to hit new highs. I don't think that's a bad thing. I think what we saw in the last 12 to 18 months has been absolutely ridiculous. 20, 30% growth is unrealistic. It's unsustainable. So to see prices increase in a slower fashion and slow and steady, I think is going to be much better for all that are trying to get in the market, especially first homeowners, as we've seen get completely priced out a lot of areas. So I guess in the future, if we see a slower recovery to hit those previous highs, I can't see that being a bad thing. We saw Shane Oliver from AMP Capital. He's a chief economist saying that the bigger and faster rate rises, higher inflation, poor affordability, and surging supply would fuel a steeper decline in house values in the next 6 to 9 months. He went on to say that our base case scenario is for prices to fall 20% from top to bottom, assuming interest rates peak at 2.6%. But there is a risk that if it goes above 3%, then there might be sharper declines. We've got a graph here where we can see the peak to trough declines in Sydney over previous cycles. So we can see the orange one here, which is 2004 to 2006. They had an 8% decline from peak to trough. And currently in 2022, we've seen roughly about just over 4% decline. Now, he's predicted that this could get to 20%, which would be on par with 2017, 2019, where they got all the way down. Actually, they didn't get to 12. They went to about 15%. So we might actually go further than what we've previously seen with the 5 to 6 other rate cycles. But I think the main thing we do need to remember is even if there is a 20% reduction in Sydney, we saw only last year, the 12 months preceding, with the boom cycle, there was a 28.8% increase. So it might actually just mean that the prices go back to pre-pandemic levels. We can see this on a month-by-month change. New South Wales 2.2%. For the quarter, they're down 4.7%. But interestingly, on an annual rate since the start of the year, they're still up 1.6% because of the January, February sort of rush that kept on going. That momentum in the market continued, and we started to see things go down from February. So definitely interesting to see. What we do know is that Mr. Oliver said that we'll probably see the worst of the price declines later this year, early next year, and for values to bottom out probably around September quarter next year. Now, this falls in line with some of the interest rate expectations. We see Commonwealth Bank, Westpac, they're all sort of predicting rates to peak potentially next year or early the year after. So we've seen here with Westpac's assessment, they're sort of saying the cash rate will peak in September, December next year, and then we'll see an unwinding, the interest rates to start going backwards in 2024. We saw Commonwealth Bank, their expectations were for rates to come down around that November next year. So they're predicting rates maybe will slide a little bit quicker. But we do know that, at this point in time, the predictions are the rates will peak probably sometime next year, and we could see a reversing, of course. We saw Commonwealth Bank, and now ANZ, their chief executive, has come out saying that they think it's extremely unlikely the Australian economy will enter a recession. And they're mainly saying that that's because of the resilience of the nation's strong trade, unemployment, and savings pool buffer. So there is a little bit of silver lining in what at the moment seems to be a lot of doom and gloom. Now, they are saying, so prices would be more or less a deeper fall, but we may see the bottom faster than we originally were thinking from top to bottom. Mr. Oliver was actually thinking it could drag on until 2024, but what they're thinking now is that it might only be as short as 12 months from top to bottom. Now, in previous cycles, we've seen some of these declines take 12 months. So in 08, 09, that was a 12-month period. We also saw from 17 to 19, it take about 24 months from top to bottom. Same with 2006 and 2004 and 2006. So what we are seeing here from Dr. Shane Oliver is that they're expecting this to be on the shorter side, about 12 months from peak to trough. Now, with the tentative signs, they're starting to see slower consumer spending, which has really come from the aggressive rate rise that we've seen. They appear to be getting more traction than they initially thought. So it's happening earlier than a normal tightening cycle, and the accelerated pace of price declines will further depress consumer spending via the negative wealth effect. Now, it's interesting that the Reserve Bank, they've got a bunch of snapshots they look at. One of them, so when we look at the Australian composition of the economy, is household wealth as a share of income and a percentage of household debt. So they're looking at these things and keeping an eager eye on it. One of the key indicators that the Reserve Bank look at is the Australian financial stability. So house prices or asset prices, which is mainly built up with Australian house prices, is something that they keep a close eye on, as well as the fact that their monetary policy looks at the economic prosperity and welfare of the Australian people. They do keep a very eager eye on inflation. So what we might find is once inflation's back under control, they're going to be keeping an eye on what's going on with house prices, asset values, and that Australian wealth effect, because as I've mentioned here, it can have an impact on consumer spending. And we know consumer spending makes about 50% of the GDP, which is a massive key indicator that the Australian economy and Reserve Bank look at as to see how the welfare of the country is going. So this could prompt the RBA to cap the rates at around 2.6%, which is what the Commonwealth Bank had predicted later this year, early next year, and then start cutting by late 2023. So we've seen a few predictions around that. Now, the downturn in prices accelerated last month with national home values. They fell 2% over the last 3 months, which compared to what happened in the 2008 crisis and the recessions of the early 1980s and 1990s, where Sydney fell by 4.7% over this period and Melbourne fell by 3.2%. So we're starting to see things slow down. Now, prices and the home price cycle is more notably seen and having an impact on the Sydney and Melbourne market, with much of the boom prices that we saw in the 2020 pandemic lows. We're starting to see that, if you bought during that time, you might be finding you're in a negative equity position where we're seeing prices really reverse back to where they were prior to that. In Sydney, housing values peaked in February this year based on CoreLogic's data, and since have fell about 5.9%, which is the fastest rate of decline than any previous period other than the 2007-2019 downturn, and the same number of days on market as what we saw in 2017. So we're seeing days on market increase there. Now, one thing to keep in mind, if we compare the 2016-17 cycle, they'd had about a 16% increase on growth. We saw recently the previous cycle, we saw a 28% increase on growth. So for us to see that decline happening at a faster rate than what has previously happened makes a lot of sense, because there's a far greater increase in values. Now, moving on, we saw Argentina have a shocking hike to their cash rate. They're sitting at 69.5%. So that is absolute craziness over there. We saw that they shockingly increased their cash rate to the 69.5% recently, and that was based on a 7.4% jump for the month of July alone for inflation. So they've got massive issues with inflation. We're talking about an inflation around that 6.1% and how bad that is. Well, Argentina has some huge problems. They're sitting at an inflation-based annualized surge of 71%. And that's hence why they've got massive rate hike increases. Now, the Argentinian government has also said they refuse to print any more money, and that the outlook looks pretty grim as the Reserve Bank is forecasting inflation to hit 90%. So yeah, look, I think pretty crazy to see what's going on across there in Argentina. As we talked about earlier, Here at Hunter Galloway, we're mortgage brokers. We're based in Australia. We deal with people Australia-wide. If you need assistance with finance, we'd love to help. Give us a call on 1300 088 065 or visit our website, huntergalloway.com.au, and fill in a contact form, and we'd love to have a chat. Guys, leave a comment below. If you have a question, you'd like us to cover it, we're always happy to read it, review it, and see what we can do. And as always, thanks for watching.